Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, active, passive, whether you're on the ownership side, you're on LP, or you're working in the industry, you're in the right spot. Every single week on the Gray Report, we're breaking down the latest research and articles following multifamily commercial real estate and taking a look at the macro economy. We've got a great slate of reports and articles today. The first one we're going to be talking about, Flow, the multifamily investment firm from the former WeWork CEO Adam Neumann. He's gotten a huge injection of cash from Mark Andreesen, the famous venture capitalist. Is there anything actually unique about the company Flow? Are they doing anything that is pushing the envelope, or is it just a highly monetized A-class apartment community that we've all seen before? But beyond that, articles from TREP, National Association of Home Builders, and a new report from Cushman and Wakefield giving us a midpoint check on where we are in the commercial real estate market. We're going to strap in, watch the full episode. Let's get into it. All right, welcome back to the report. I'm joined again by Director of Communications and Marketing at Gray Capital, producer of the Gray Report, Dr. Matt Bosnagel. Matt, how are we doing today?
Hey, pretty good. It's been exciting. I was sharing so much with you yesterday because you're off in looks like half a continent away, or maybe a couple of continents away.
Right on the edge.
I don't think we're doing as exciting as you. Yeah.
I don't know. There's a lot of good stuff going on at Gray Capital back in Indy. I am reporting on location. Right on the footsteps of empires in Istanbul, right on the Bosphorus, doing some observation of the sea lanes, trying to see where the global economy is headed. Just kidding. I am on family vacation, but I had to make time to do another episode of the Gray Report because there's so much going on in the market. And Matt, you're keeping us on point. All right, look, I just want to jump into this article from BizNow. It's on, it's another iteration and update from Adam Neumann's company Flow, which, we remember Adam Neumann, former CEO of WeWork. You may have seen the movie to be familiar, read a bunch of articles, huge business that was in the co-working space, a little bit of an implosion, massive valuation fueled by SoftBank. And many are questioning right now, are we seeing a similar tale, with a huge sales pitch about, community and buying these nice brand new A-class apartments, highly amenitizing them, again, creating the types of vibes for millennials and Gen Zs, renters that apparently they can't find anywhere else. And we've talked about this before, but as Matt, you noted in the show notes, and we've discussed on previous episodes, at one point, it was just a website that said Flow, and we weren't really sure, what the product was going to be. But now that they're a few years in, I know they bought a couple assets. I think higher interest rates and the challenges in the multifamily market probably subdued some of the growth. But looks like they're raising real money here, Matt, that they could be a serious player. Bring us up to speed. What's going on with Flow?
So there's no monetary value that has yet been ascribed to it, but there's been this new announcement from Mark Andreesen that they are doubling down on Flow, is the words that he uses in his announcement, and it's basically a restatement of confidence. The initial statement of confidence was in 2022, talking about how the nation has a housing crisis. And I like the way that they characterize this. Again, this is in August of 2022, the initial $350 million investment from Andreesen Horowitz. And he said, oh man, look at what happens when you're renting an apartment. It's a soulless experience. Do you even meet your neighbors? Are you proud to bring your friends and family there? I mean, come on, it is just a horrible experience here renting an apartment. And then to cut to now, people still need homes. They still need things, and that's why they're doubling down on Flow. So I don't know if they are investing 700 million, because that's what double is in my opinion, or if they're just kind of giving an update and giving another vote of confidence. But they're saying that Flow's buildings crush market benchmarks, higher revenue, better profits, a brand unlike anything in real estate. And their technology that reimagines what's possible for owners, operators, investors, and residents. So this is a big apartment syndication firm, is what I take it, and it looks like this. So I have here the Flow website that's up, and it is heavy on the kind of lifestyle, heavy on young people. And I just kind of ran this by our property management, and they were like, yeah, well, they're kind of leaving out older renters, maybe maybe they're leaving out a clientele, but they have a lot of promises. And I increasingly, as I went through their website, I'm thinking about how much it is to kind of like run all of this stuff, all the spaces that they're saying that they have, and to make sure that renters are happy, and how to do that in a way that makes financial sense. So that was my immediate take about Flow was, yes, highly amenitized, but are these amenities? Is everyone gonna want to go kayaking every weekend? I don't know. I don't think so.
Well, it doesn't matter though, right? But that doesn't matter. I mean, you could say that about any apartment amenity, right? I mean, the gym, the pool, the aqua lounge, the golf simulator. None of these things are used daily or weekly by the residents, and so often an amenity is supposed to provide, the idea that you could use it. It's the hope. It's the idea of imagine yourself living in this environment. We talk about amenities on the acquisition side often, sometimes as pure leasing tools. Like, no one may actually use this, but let's have it because they might like the idea of using it. And if they do use it, that's great. Get a great experience. Hopefully that leads to higher rates of retention. It's the same reason why we're seeing in markets that can do this, that don't get too cold in the winter, leaving pools not necessarily open, but not necessarily closing them, covering them up either. Having a really nice looking pool for a tour, even though it's not actually open to swim in, but you want to have the aesthetics and give the impression that, look, you're going to be, when summer comes around, you're going to be swimming and having a good time. Mm-hmm. One question that comes to, so they're just kind of taking that to an extreme. I mean, and the question that I have is two, one, have $350 million, that would buy a lot of apartments. That would buy, close to, over 10 apartment buildings, if that's all equity, depending on if it was, equity or debt. I'm assuming it was an equity injection. Certainly, they were probably going to take a lot of that money to, put into the corporate entity. I'm assuming just that's how, these more venture capitalists, startups, the types of companies operate rather than traditional real estate company. But that's the question: is this more of a traditional real estate company, or is it something different? And I'm seeing nothing that leads me to believe that it's anything other than a traditional real estate company. They just have really high-end amenities, offer experiences, which is on the close to the leading edge, but they're certainly not the only ones doing it by far. I mean, we have a property in Indianapolis, Matt, that we're offering kayaks and boat tours and all kinds of things, and we're looking at things all the time. And there's a lot of folks that are working in multifamily to add additional amenities, concierge type amenities and services to A-class properties. Does everyone have a meditation room or a practice room? No. I bet not every Flow, a property does either. I'm sure they're highlighting a few specific examples. So it boggles my mind. It can be a good idea. I mean, if you're in a market with that type of demand, I don't think it matters necessarily that you're not going to capture like the empty nesters, older demographic, and they certainly make up the second largest percentage of renters. But the highest percentage of renters, clearly are going to be in your early 20s to your mid 30s. That age group is widening somewhat, but that's your core renting demographic, assuming that they can afford to live in a place like this. But again, if you're in a place like Miami, Fort Lauderdale, or in Saudi Arabia, as I saw one of those locations,
Riyadh, Saudi Arabia,
you might have that young professional with a lot of money that isn't looking to buy. They're looking for a little bit more of a transient lifestyle, and isn't everyone looking for community? So I'd say it's not a bad like concept. We've worked on similar things at Gray Residential and Gray Capital. It's just it has so much hype in the way that it's discussed as a novel idea. And it certainly looks sexy, but I don't think it's novel. And I'm really curious on the valuations.
Yeah.
And if they are overpaying for some of these assets, assuming they'll be able to achieve much higher rent premiums than market because they have, some special brand or some special sauce. And perhaps that could be the case. But I mean, when I'm looking at articles, I think they just sold one of their properties that they bought in Nashville at a loss. So, maybe that's just market timing. But, again, and I'd have to ask, why would they sell necessarily so relatively early on into this venture at a loss and instead of holding on for a longer period?
Yeah, I think that I think that's totally true, and it made me think about something that was rattling around in the back of my head as I was thinking about flow this week. Was this idea that venture capital and like Silicon Valley, they will often try to kind of dominate the space, and they will maybe drive down the prices so that think about like Uber, they were maybe operating at a loss for a little while, and in order to make the price and build up that customer base. And same with a million of these social media companies, they had so much runway that they could build that base, and then by the time that they were like ready to make money and ready to kind of turn on the money machine and charge people and whatever, they had a dominant position in the market. But I don't know if that's going to be attainable in the apartment market. It's a lot bigger, and the pressures to make money, and to stay afloat kind of, are a lot more if you're maintaining a building versus if you're maintaining code. However, yes, there's probably a lot of nightmares if you're thinking about like a Twitter, Facebook, or TikTok. There's a lot of things that could go wrong in there, but just as much could go wrong in where you're living. And I just wanted to note here, this is in the paragraph that Mark Andreesen he wrote this recent note, and in his most recent note, he talks about how they're buying and developing real estate made more valuable by the Flow platform. In South Florida alone, Flow and its partners just acquired projects for over 3,000 apartments, allowing it to create entire neighborhoods built on the Flow vision. I think that this is a Silicon Valley idealism, kind of like, we're going to own the entire space. We are going to dominate. This whole neighborhood is going to be Flow, and we're going to have this kind of control over it in the same way that we control, the remote, the automatic cars or the Uber in an area. There's that kind of,
and it just it's a little bit of hubris though. I mean, and again, that paragraph of where the value is going to be driven by the Flow platform. Well, maybe, but you can only really extract that value and you sell it to another operator. And can another operator make sense of that operating model? Can they sustain that, and can Flow actually sustain it? Are they actually cash flowing, or do they not care about cash flow and they think they're going to get some huge exit? And that's the difference when we're talking about when we're talking about like real estate compared to like a startup or a venture capital investment. The venture capital investment, the idea is that it's going to 100x, it's going to like 1,000x because you're going to scale it across this large market. An individual property, I mean, it's, linear growth on net operating income, and then you can make a pop by a value increase. When you sell it, you take the net operating income, you divide it by the market cap rate. And you can get a nice premium and you can make some money doing it, but you're not, taking something in 100xing or 1,000xing or something. You're taking a piece of technology that a billion people across the world can use. You're buying a building that a very limited amount of people can use, and you're only targeting a subset of the population. Only a certain amount of people are going to be in the highest income demographic that are renters are going to be able to afford this. Mm-hmm. Now, fortunately for Flow, though, I mean, there is a lot of folks that can no longer afford to buy a home. They're making good money. They don't want to buy something. So, I mean, there's definitely is a market for this. But, again, the whole idea that they're going to get this really strong valuation. And if you go back to that last page, the paragraph, the paragraph below that, it was talking about, they're working on these other ideas such as, democratizing real estate, using the blockchain. I mean, that's just, if that's not the red flag, or it's a red flag, it's a red herring, it's a distraction. to say that we're going to create this extreme value to do something different. And they're not the first ones that have tried to do this. And I've read other reporting that it's this kind of concept of having, the renters get some sort of ownership. Again, it's a really interesting concept, but it really doesn't pencil out that much. Renters aren't necessarily that interested in it. And again, if you're giving ownership over to renters, you're diluting value to the actual other owners of the asset itself. And it sounds like a lot of buzzwords, a lot of hype to make it have a blended tech component to get maybe a higher valuation. But again, good luck selling that to someone and telling them to here's your democratized blockchain cap table of renters. Good luck. Or does that cap table extend on? It's a little confusing. I think it's a lot of buzz, but the concept of providing a highly monetized space to, wanting millennials, Gen Z, that's not crazy, but given a crazy valuation is.
Yeah, no, I totally agree. I think that part with the blockchain, you called it a red herring, a red flag. I think for some reason, for some people, I think it's a green flag. I think that is the special sauce that gets people jazzed. And that was present in the seeds of this idea was present in the 2022 note that he said when he's talking about how you can pay rent for decades and still own zero equity. This was born in the kind of waning period of maybe NFTs and crypto, and like right before, I think it was actually like a month later that ChatGPT launched, or like the popular iteration of ChatGPT launched in 2022. But I think that crypto is a big part of the conceptual underpinning that gets someone like Marc Andreessen excited. And I only say this, and maybe it's a little bit of literary analysis, but because this paragraph where he talks about finding ways on blockchain to democratize real estate, and then he spends the next one like he's more like emotional about this blockchain idea and equity than he is about a lot of other ones, because he's talking about a lot of other ideas that he writes about. He says, when people own stakes in their communities, they invest and they live, they build relationships, they create the bonds that make places feel like home. This matters enormously in a world pulling us towards isolation and screens. So I think he's really invested in this idea of, I think specifically crypto. They're going to slot you in with like a flow bucks. You're going to rent. I think that this is what they're working on, quote unquote. You're going to rent, and for every $1,000 of rent, you'll get 100 flow bucks. And I don't know what you're going to spend those flow bucks are, but those are yours. You have them, those equity. That's real money there. You got your flow bucks. You maybe can get a Snicker bar at the commissary, but I don't know. Oh,
they won't have Snicker bars, Matt. They're going to have some organic granola bar of sorts.
Yeah, no, that's true. I think that they haven't figured out a way to turn that idea of crypto into something that actually people want. I don't know what they want. I'm trying to feed them Snicker bars when they're probably they're going to want some kind of organic thing. But I don't think they necessarily want Flowbucks either.
What problem? I mean, they said
exactly.
The problem is that that people don't care about their communities if they don't own stakes in those communities. Well, again, apartments by their nature are somewhat transitory. I mean, typically you're going to see 50% of that apartment community turnover in a given year. On a high end, maybe 60, but 70, but then it's going to revert down. Some years you might even see 30 or 40%. So you're not going to have a population that's necessarily going to live there for a long time. I mean, some people do. I mean, we have residents that have lived in our communities for 10, 15, even 20 years. But that's very, very rare. What problem are we solving for? Is it basically like a rewards like program, like you're basically saying, which, again, this is just a fancier way to have like a punch card to punch it and you can trade it in for a free, yoga session.
Well, I think that's a good point. I think what problem is it solving? But I also looked at it in this way, like, what is their real contribution? What is their innovation here? And I was kind of beating around the bush here and talking about it, and you kind of were mentioning too. A lot of this is what apartment syndicators, apartment operators, property managers are already doing. It may be amped up in a way, but we have been quietly innovating for a long time. And I think that this carries the assumption that all of apartments are really crappy. No one wants to live there. No one has done anything to meaningfully improve the the experience of renting apartments or operating apartments. There's no apps there. No one uses technology when they're in the multifamily space. And we're going to come in here. It will be like sitting at an empty table and eating our fill, because we are going to run laps around these people and no one's going to be there doing the same thing. When in reality, again, we have been quietly innovated. I said this to Katrina as I left yesterday. I was like, I'll be here tomorrow, quietly innovating. We may not be as loud or have the hype and branding of Flow, but we are doing the same work that they're doing. They just kind of assumed that we weren't. And I can point you to probably a half dozen National Apartment Association seminars on a sense of ownership and building a sense of community. Like, this is stuff that we work on. This is stuff that property managers are thinking about day in and day out. And to assume that it's not is a little bit of hubris, I think, like you said, but it's also like a really expensive mistake. So I wonder if they're going to, maybe they will be able to float for a little while, or to flow for a little while. But
flow, yeah.
And this is what I was thinking
Flow,
too, man.
flow.
That flow is not, it ain't cash flow. I don't think that's the flow they're talking about. But I singled out Katrina, who is the head of property management at Gray Capital Gray Residential. And I looked and I asked her, like, okay, what do you think about this? Are they doing anything different? And she said, well, the design is really nice. This practice room, this meditation room, Pilates room, it looks really cool, but it's not necessarily any different. It's just like an upscale version of what we do, what similar apartments do. I like how the pool is described as arguably one of the better rooftop pools in South Florida. But that aside, a lot of this stuff is extra. It's got a Pilates room, a meditation room, a practice room, and a fitness center all in one. And it's got and all these other amenities. There's a lobby cafe and bar, Flow social lounge, a well-being cafe, a game room, a Flow food truck, lobby cafe bar. I already flipped around there. Podcast room, private offices, co-working spaces, and this app. So I want to get to that app in just a second. But all of these things are you can have that in your apartment. That's not in there exists podcast rooms in apartments. I'm pretty sure we've got a little podcast room in one of our properties. So this is not revolutionary. It's just maybe a bunch of stuff all in one place. And the biggest question I have looking through all of this stuff, and maybe I have got here, all of these events, how are they going to pull this off? And does it work? Are people going to all these dang kayaking events or whatever it is?
But again, it's not necessarily. Community events aren't a new thing. It's a great tool that we do at our communities, and a ton of communities do community events. It's a great thing to do. It's low cost. Residents absolutely love it. I don't know if they've got like a name brand DJ or whatever to make theirs like very unique. But again, where I don't think they're wrong, and to play not even the other side, but I think the highlighting, I think just the facts. The average property manager apartment community isn't that great. And I think you and I are coming from a little bit of a different perspective, because we talk all the time about how property management can be different, and the experiences that renters are having, and trying to improve those as much as possible. We're actively living and breathing this stuff, and we're working on it, as other firms are too. We're not the only ones. And so for us, it's like this is obvious, but we also hear, me and Katrina and other folks say all the time that, your average property manager really is not always doing those things. Some are playing catch up right now.
Yeah.
But the average renting experience isn't that great. So they're not wrong when they say that. They're just not correct when they say, they're the only ones that have thought about doing a better job, and they're coming in from the outside, and the architecture looks great. The design is beautiful. Give them that. Yeah, man, CapEx. I'd love to see what their sources and uses are. I'd love to see their CapEx budget. That's none of this is free, and how much rent will it be willing to pay?
Because ultimately you do have to cash flow. Ultimately, like if they want to, and we've said this before in the gray report, this is like not a passive income. This is a marginal income industry, and you've got to keep the lights on. And I keep thinking of the Well-Being Cafe, game room, Flow Social Lounge, podcast room, and conference room. What if they sit empty all day? And like, and surely, like at some point,
they do sit empty most of the day.
And so at some point you have to think, and correct me if I'm wrong, I think this happened in a lot of WeWork places, is eventually the kombucha on tap, that kind of went away because the people that were paying for the leases would rather pay a little bit less and get something a little more efficient than have all these amenities that they just don't use. So if you're paying for amenities that people don't use for the appearance and the kind of branding, I don't know if that's a really if people are willing to pay the rent premium for that. Is my own that's my only kind of comment there. Is like people have tried this before, but a lot of times people just don't show up. Maybe they do in Miami or Riyadh.
No, I'm sure there is demand in those markets. I imagine what their exit plan most likely is that they assemble a large enough portfolio and they go to UPREIT and form a REIT, real estate investment trust, where they can access the public markets and use that hype to sell to retail investors. And investors across the world. I mean, to me, that makes the most sense because then, they still have to be able to distribute, their dividends if they create any dividends, but, possibly less scrutiny than the structure of, like a private placement or fund structure. That makes the most sense to me. That would be my play if it's all hype, again, taking this on the road show. People are already believing Adam Neumann, again, to do something that is seemingly worth more than everyone else think it should be. But there are people out there that believe him.
The other thing that I thought about Flow as maybe a potential contribution. So in addition to the idea of the blockchain, so we've just talked about like the amenities and stuff. That's kind of what people have done. I can wrap my head around that. But also it's like, we're doing this every day, nothing new. Maybe potentially this idea of so this is a screen I have right now. It says own seamlessly in Flow. So it looks like you can buy a unit in the Flow system, and they have an app here, and you can kind of manage the property, do the property management, and do the marketing for that unit within this ecosystem of Flow. And there's an app that kind of connects that. It's really slick, and I'm sure that they executed on that app really well because of the Andreesen Horowitz connections in Silicon Valley. And sure, WeWork has a lot of talent that Adam Neumann drew from the previous talent at WeWork. I'm sure they nailed the app. But this idea that you can maybe own a unit and maybe rent it for shorter term rentals rather than like just a year, I think that's potentially kind of interesting. So I'll have to see how that actually looks because I don't have the specifics here. But at least that stood out to me as being different. Other than that, though, sorry.
Oh, no, you're good. I'm just looking at some of their listings right now. I mean, it doesn't necessarily look like the rents are. I mean, the studios for 1,700. It's only 356 square feet. And that is in Fort Lauderdale. I mean, it's expensive, but that might be what a studio goes for in Fort Lauderdale. I'd have to just cross-reference on CoStar. They also are offering, furnished apartments for $386 a month. For a 2-bedroom, and this is in Fort Lauderdale. But what's interesting is, they don't really the apartments don't have names. They're just called Flow, I guess. And you can get information on certain units, but it's not like the property itself has a website. It's just, Flow has different locations, which is, a little bit different. A lot of groups have tried this, idea of, branding. Branding across several communities, and a lot of groups attempt to do it. There's hasn't been a lot of evidence for brand loyalty. Yeah.
How about this? They say 21 perfect matches. when when you pull up the
Perfect.
rents, it's like, oh wow, okay, that's just a little bit of marketing. I thought that was funny. At the end, I kind of come away with the idea of Flow as a multifamily company. That's kind of probably the core thing. I don't know if he's trying to make it into kind of an everything app or anything. I don't think that that the aspirations are as wide reaching as they were when he was at WeWork and he wanted like everything, the branding to kind of expand beyond the limits. But who knows? I keep thinking of the timing of this extra investment, and it's like, well, it started in 2022 when home prices were high, when apartment prices were high, and then that was almost
And
like
rent growth was high.
and rent growth was high, and that was almost like pretty much the peak of the market. 2023 and 2024, there were very significant valuation decreases for apartments. Well, it's no surprise we didn't hear much from Flow, and now that arguably there's a sense that multifamily has bottomed and is on the way up, now we're suddenly seeing Mark Andreesen saying, "Hey guys, Flow, let's get this moving. This is a perfect time to invest." And so that's what I wonder, if they're positioning themselves just to be another company. I want to bring up there's a quote from New York Magazine that summarizes this perfectly. It says, "While no one I spoke with expected Flow to do anything revolutionary, the developer pointed out that Neumann, I don't know, might very well pull a Compass, which is a commercial real estate brokerage, raise tons of capital by promising revolution and cutting edge tech. And by the time it's clear that the revolutionary stuff isn't going to pan out, it has become a huge, albeit largely traditional, player in the industry." I think that could happen. He could come away with this and just have a bunch of apartments that are cash flowing. Let's hope that is solved, because I think the only real potential pitfall here is investing too much in amenities and running like a cash flow negative business for too long, thinking that you're going to kind of, I don't know, take over the space. And I don't think that that's as possible in apartments. It's not this unclaimed frontier. It's already claimed by a lot of people.
Very, very true. And again, we mentioned this earlier, but I mean, they've already faced, cash crunches at their Nashville apartments, which it's not listed on their website, but Yield Street, according to a Real Deal article, dated back in January 2024, Yield Street opened a fund to raise essentially rescue capital for some Flow properties, essentially to purchase additional rate caps as well as cash flow deficits.
Interesting.
And then again, there's another report that property sold below the price that they purchase it for. So again, already some hiccups, and for other companies that would have kind of started a venture in the space, already having like a failed project kind of in the first 2 years isn't a great start to things. And again, they mentioned 3,000 units, 4,000 units. I'm only seeing 3 locations. Where are all of these units? Yeah. And what did that $350 million buy? Maybe there's flows everywhere, but they're just hidden.
Oh, they're not cash flow positive. As of May 15th, which is when that article that I was just reading from, the end of the article said like Flow was recently, a spokesman for Flow recently was quoted by saying, "And we expect to be cash flow positive by the end of 2025. So not yet. They're not making money yet. And 2022, no money. 23, 24. 25. That's a lot. Like if we had a syndication and the first 3 or 4 years were cash flow negative, I don't know if we'd be able to. I think that there'll be difficult calls with investors, but I think that venture capitalists maybe have a different idea. And
they don't look for that. They don't expect cash flow. If it's a growth business, again, I just don't know where the growth
exactly,
where that exponential curve above the rest of the market comes from.
Yeah.
And maybe they're talking about their operating business, which isn't necessarily a unique thing in real estate. But if they're talking about the real estate itself, then that is not a great start. And you'd like to see some cash flow just for the health of the deal itself.
Yep. Totally.
Well, Matt, let's move on to this TREP piece.
You can tell I love talking about this, though. I love talking about.
I know you do. It's interesting, and I think it's a good case study to continue to track. I really do, because again, I don't think they're. I think like Karl Marx, I mean, some of the observations weren't necessarily wrong. It's just some of the execution and kind of the concepts that's where it really falls short. So again, not horrible analysis of the situation itself, but
Just identifies
gotta
housing
put
is yeah.
gotta pull the BS card on the execution.
Yeah, for sure.
Okay, Trev, housing becomes a luxury good. Good news for apartments.
Yep.
Matt, bring us up to speed. What's going on? I mean, I mean,
So
every person needs a place to live. You know, is housing really a luxury good these days?
So I'm pairing this article from TREP with another piece of data from NAHB, and this kind of follows a couple of weeks where we have been following the single family home price growth declines. So there's like a softening in the single family home for sale market, and this article still kind of reemphasizes that housing, specifically for sale homes, are becoming this luxury good. Right now, what this graph shows right now is how it has become increasingly difficult to qualify for purchase of a home or for renting a home. I had to wrap my head around this a little bit. I had to spend some time thinking about this because at first I was like, wait, is this rent to income? No. This is, I guess, just to qualify to pay rent. Right now, you have to be making 71% of median household income just to qualify to pay rent. That one makes me my eyebrows raise a little bit when I see a number like that. So I'm not really sure of how accurate it is. But what they are tracking is this progression from 20 years ago. You needed only 37% of median household income to qualify to pay rent for the median apartment. And then now it's a little under double, so 71% of income. And compare that to buy a home, you needed in 2005 87% of median income to qualify to purchase a home, and now you need 152% of median household income. But I think the real increase wasn't from 2005 to 2025. It was these 4 short years between 2021 and 2025 when it went from 90%, which is only 3% more than it was in like 20 years ago. Yeah. So it went from 90% all the way up to 156% in like 3 short years. Now it dipped a little to 152, but still the biggest increase happened in the shortest span of time. I think that it was a kind of perfect storm of high mortgage rates and high home prices that is still there. And that gives credence to this conception they have of homes as a luxury good. I'm just going to kind of scroll down to the bottom here. Is they say if one accepts the premise, or as we postulate the reality, that housing is now more of a luxury good than pure necessity for purchase, then one needs to expect consumer spending dynamics to act accordingly. Higher quality, more scarce homes and apartments for sale will command higher and higher prices. The more commodity the housing unit, the more its price, value, and rent will fluctuate with local supply, and that means faster rent growth, but also or price and rent growth, but also higher downside sensitivity. They don't say it specifically here, but I think that they are positioning multifamily and rental housing as a commodity good and purchasing homes as a luxury good. It kind of makes sense in that, like, this is scarce volume, sales volumes, high prices that are kind of persistently high, and like there's not a lot of it. So that makes sense for home prices. I just don't think that multifamily is as much of a commodity as they are saying in this article. I think that there are plenty of luxury multifamily homes that can maintain persistently high prices. Also, the different construction story for single family homes and multifamily homes makes this a little bit difficult. It's not so easy a division between luxury and commodity.
It's a really interesting concept, Matt, to think about. I mean, we're really talking about elasticity here, and typically housing is pretty inelastic, but certainly there's always been luxury real estate, and there is a part of the market that is quite elastic, and in terms that it has, price affects demand considerably. If there's a downturn in the economy, well, again, people still need a place to live. Rents might decrease by, marginal amounts, but there's still a significant amount of demand there that keeps prices, relatively in check. But if you're talking about the highest end of the market, unless in a scenario where that demographic is somewhat shielded from an economic downturn, but we've seen in economic cycles, luxury goods demand decreases when we see
Yeah.
economic turbulence and an economic downfall.
Yeah.
Float certainly seems like a luxury good and a type of
Yes,
luxury housing.
that's true. That's a really
Again,
good point.
it's just one example, but
Yeah.
we call it renters by choice, renters by necessity, or I'm just thinking about our portfolio and the history
Hmm.
of our portfolio. Just for some anecdotes, we clearly have some product type that would falls more into the commoditized real estate, that is
Hmm.
highly inelastic, that just we're serving more workforce housing. We kind of the two buckets that we focus on is kind of either being like the best B in the market, kind of call it like B plus, really solid, high quality, high value workforce housing, still highly amenitized, but a little bit older. But then our even more highly amenitized Class A product, really kind of
Hmm.
core plus investment strategies. Now, even that core plus product is relatively inelastic because we're not at the absolute top end of the market. But we have some units at some properties that they've either gone through like an ultra premium renovation, or I got a property salon in Indianapolis, Matt. Some of
Hmm.
those units were built originally as for sale condos or townhomes. So the floor plans are very large. There's custom cabinets, custom countertops,
Yeah.
3,000 square foot units. There's a relatively narrow subset of demographic that's looking for that, but it's a huge demand. It's a luxury item. But
Yeah.
if you're looking, you've got the money to spend and you want to rent a place and you want a lot of room in a nice place, there's not very many around. And so it's all of a
Hmm.
sudden treated like our luxury good. There's a ton of demand, and we get some of the most massive rent premiums on some of those large, ultra expensive units. But
It's gonna be
if
different
we're
for
in a
different markets,
scenario
I think.
where if a different market with the economy's crashing, or
Yeah.
certainly a different geography,
Yeah.
not going to fare as well. Fortunately, we have a very small percentage of those floor plans, at that one community. So it's not like all of the eggs are in that type of demand bucket. But it's clear, we talk about those types of rentals and the demographic that searches from highest to lowest. When you filter prices, most people, your average person, filters from lowest to highest. Show me the cheapest stuff first. What can I afford?
Yeah.
Beyond just like the normal filtering, there's certainly part of the population. It's like, I want to know what the nicest thing you have is. What's the most
Hmm.
expensive thing you got? Now, nicest and most expensive aren't always the same thing, but to get there quickly, you're searching from highest to lowest. They want the nicest thing available. I've got the money to spend. I'm only going to be in this town for a year. Or what often happens, oh, I've just gotten divorced. I need a place to live, but I'm left my single family home that I own. I want to rent a place. I'm going to be bringing my kids over. I want it to be pretty nice. So I'm going to look for a townhome or a really nice apartment.
Yeah.
So clearly the demand's there, and that I see much more as that luxury good.
Yeah, yeah. I think that makes sense. And Tripp has actually also identified a couple of implications for this idea of rising home prices and homes as a luxury good. A lot of them we've talked about, specifically the continued demand for apartments in the face of rising single family home costs and the purchase cost. But also, I I'm kind of interested in what they say about geographically and shifting preferences based on like moving to more affordable locations, basically. I think that
Mm.
they conflate moving from one location to another with moving from within, but maybe they don't. I think that it's a similar impulse that basically, if home prices are more expensive, you want to go somewhere where it's less expensive. It's a little bit different though to move to like a suburb that's an hour away from the city to get a cheaper house than to move from an expensive city to to a less expensive city. I think as we had as we had mentioned on the Gray Report a few years ago, the more likely move is a movement from downtown to suburb within the same larger metro area versus moving from market to market, from city to city. However, I'm sure that there is a little bit of in-migration because of affordability. It's just something that we'll have to watch.
Sure.
Yeah, a little bit of counterbalance between that and the South. But South is becoming more cheap, a cheaper place to live if they keep building apartments there. And that was something else I was thinking of. Luxury apartments may be a premium in certain places, but if they've built a lot of luxury apartments, then maybe rent growth goes down. If all the new apartments are luxury apartments, then that's a little bit more of a elastic pricing.
Oh, there's some deals. Matt, right now you go down to Austin, you can get some sweet deals on apartments.
Yeah.
I mean, it was like early on in the pandemic, those pandemic specials, especially in the big cities like New York City, they were almost, rents were being slashed. They were almost giving the apartments away. I mean, I remember, again, this was before the prices just spiked up. I mean, remember there was that period where everyone was like, we don't know what's going to happen. Yep. Everything is, crashing maybe. My first experience was we went to go buy a new car for my wife, Alex, or we were leasing a car. We were just looking at the options and went in thinking, hey, I think we're going to have some negotiating power. And they're like, we don't have any cars. Everyone's buying cars. What are you talking about? Well, there was that but even before that, I mean, I remember we were able to go and rent, incredible, suite at a hotel down in Miami for I mean, it was like fraction of the cost what it would normally be. This incredible room, because no one was traveling. They were almost giving the rooms away. They're just trying to solve for occupancy. That only lasted so long. And, so, I think everyone needs to kind of remember what's happened in the past, and going back to kind of the causation of all of this, what we've talked about before, Matt. We said, single family home prices are so high, rents, the spread is so wide. Something needs to allow those numbers to converge. It's either going to be interest rates come down, rents spike, or single family home values decline. Now, it can be a combination of those things, but with interest rates staying steady, rents are growing a little bit in some markets, flat in others, negative in others. The only thing that's going to give is home prices coming down somewhat. The challenge is there's only been so much inventory, and there's enough demand to meet that little bit of inventory. But again, if nothing changes, those valuations, I can see them stepping down or at least having resistance for significant further growth.
Yep, totally. I just maybe jump the gun here, but that's what this NAHB article it basically outlines. It doesn't outline sales prices. It's talking about household real estate asset value falling, not just sales price. Again, this is not the how much you sell your home for, and that is going, that price growth. This is actually like a nominal decrease for the past 3 quarters. The price of people that already own the homes is going down. There's not much to this article. It's just this data point, but I wanted to raise this because this is approaching a point where these quarter by quarter decreases in existing home values are going to flip over to a year-over-year decrease, and it's just another sign of softness in the for sale home market. And it's easy, maybe not so easy, because actually, whenever I look around and whenever I talk, to my family about how much did this house sell by, then I'm always thinking, well, maybe that means my house will sell for a little higher or a little lower, and that's exactly what's happening here. Is home prices. Our homes are selling for less, and let's say you live next door. Well, your home price is probably going to be valued. Your home is going to be valued at a little less as well. Does that make sense a little? Or I don't know. I always think.
It does make sense. But I mean, again, a little bit of perspective. I mean, looking at this chart, I mean, boohoo, homeowners. I mean, look at that value growth since 2013, essentially, and look at the liabilities. I mean, we take on, a little bit more debt, but the valuations are through the roof. So, I mean, I think totally that home values probably have the room to correct a little bit, and people are in fixed rate, loans. They're not going to be underwater. The note's not going to be called. They'll be just fine, and there will be further price growth as the market stabilizes over time eventually. Now, does that keep people locked in and trapped into homes longer than they had originally anticipated? That's already going on. That most likely will be the case. But again, I don't think we're going to see much change until we see movements in interest rates. I mean, that'll be the big kicker. But on the other side, if interest rates come down, that will allow essentially, home prices to stay somewhat elevated, as there's a ton of pent up demand as older millennials who haven't bought a home are on the
That's what I was thinking too,
sidelines
for
chomping at the
sure.
bit.
Yep, I totally think about, yeah. It's going to be it'll be a little bit of rest before home prices come back up again. And I'm also thinking that that this difference between apartments and home prices is, so we've said this before, and lots of people have shown the same graph. Like right now, you could probably replace that line, this lower red line, with the price of rents, as like, oh, rents have steadily increased while home prices have catastrophically increased. What I'm trying to say is there's also another argument that when home prices increase, rents increase. When home prices go down, rents go down. What's the problem with that is that for the last 3 years, home prices have gone up a lot, and rents have not really. So there's already been a bifurcation with rents and home prices, in that rents have been much softer than home prices in the past few years. So given that it's already shown this separation, I think that maybe there is room for further independent action of these two sectors of the of the housing market. So it's only like, I think maybe it's true because it's been true in the past, but whatever. Maybe I'm wrong. That's just a little bit of speculation, but we'll have to look and see how that plays out. I don't know if you want to talk about a little bit about the rest of the CRE market.
Yeah, let's dig into this new report from Cushman & Wakefield. Midpoint 2025, uncertainty looms. Again, as they said, stay alive until 25. Well, if you are listening to this, you are still alive, but maybe not faring as well as you had hoped. And before we even started this, I asked Matt, should we talk about the recent conflict in the Middle East between Iran and Israel? Not because it has anything directly to do with commercial real estate or multifamily, but certainly adds to the stack of uncertainty and could easily impact bonds and interest rates. But that title of just more uncertainty is absolutely correct. But let's first get into this report from Cushman & Wakefield.
Yeah. They note a little bit of that larger uncertainty with the trade and foreign policy, but not necessarily like the war aspect, because that is a big question mark. They just, to kind of summarize the economic policy angle, there are higher tariffs. This is all up in the air, kind of, and that's why these are just areas of uncertainty that they cover here in the Cushman Wakefield point. But it's still a good point that they're making, and I'm glad that they're laying everything out here on this page, and it's hard to. It's almost difficult to comprehend how much movement and how much little things are shaking things up right now. But just to name some highlights: higher tariffs, lower taxes, fewer regulations on the policy side, potentially privatizing the GSEs, which are like Fannie and Freddie, and that could result in 20 to 25 basis points of upward pressure on mortgage rates. And then also on the tariff side, there's this lovely chart here that shows potentially tariffs moving from currently maybe 17.5% as an estimate in tariffs, and then by July 1st, 2026, we're going to see a sharp drop in tariffs. I don't know what they are attributing that to, other than, what did they say? We assume it will continue to decline as trade deals are negotiated. So let's just hope that those trade deals are negotiated. But I'm not sure if it's going to be trade deals being negotiated or some other mechanism that may bring down tariffs. I'm not going to.
They started seeing some of that tariff revenue actually come in and start spiking. So I think there are some folks in the administration that are probably going to see that revenue as a little bit sticky. I think that the tariffs are going to come down because they're going to get negotiated. But I think that they like the idea of keeping certainly elevated tariffs compared to prior administration, because otherwise they can't pass any of these bills and spend the money and do the programs that they want to do, even with some of the cuts that they're doing, because they need the math to pencil in a way that the CBO can check off on it. Not that the math makes sense or that actually maths as reality, but they need to have the story and to be able to say we're going to be able to make the revenue up somewhere so we can do these other programs. But I think, are people over talking about tariffs? Are we done?
I think we're done talking about tariffs
until we're not.
Yes. Until we're not, but yeah, I think we're done talking about tariffs. I really desperately want to
I
be
think
done talking
everyone's.
about
I think
tariffs.
everyone is. I think the Trump administration is sick of talking about tariffs. I think the
I
entire
think so
like
too.
international. I think the world's sick of it, and they're just like, fine,
Yeah.
it's not great, okay, but whatever. So, I mean, a lot of other countries do have tariffs. I mean, I'm in Turkey right now,
Hmm.
and they've got some like random tariffs on random things. I mean, like if you get a
Yeah.
cocktail, it's like a $30 cocktail, just like the hard alcohol has a tariff on it,
Oh wow.
in a high tax on it. So again, different countries, are different. I'm big anti-tariff person generally. I'm a big anti-tax person. So
Yeah, it doesn't
tariffs
make
are
sense to me.
taxes
Exactly.
and
Yeah.
get in the way of. I want to do trade. Let's trade. I want to do. You and I, we want to trade. We shouldn't. Less the government is involved in that process. I
Yeah.
think the better. So,
Yeah.
but that's me.
So
Ooh,
maybe
stagflation, Matt.
perhaps related to, perhaps not, but there's a little more detail on the potential for stagflation. And Cushman & Wakefield say stagflation signs are already emerging. There are some elevated layoffs, maybe some contractions in manufacturing. They say that confidence is off recent highs, but this does not reflect the more recent University of Michigan increase in consumer confidence. So that's a little bit more promising. But this is interesting. It shows that the foreign origin increase in prices since March 2025 is up to 2.5% compared to 0.5% of domestic origin price increases. It's not 17%, but it is a little bit is a little bit more. I think that this is not necessarily a like sharp dagger pointing to stagflation, but it is a little bit, it's a little bit of worrying signs. I don't think that we're going to lead to full blown anything. Maybe just a little bit more raising prices. I have trouble thinking that tariffs are going to lead to anything dramatic, just based on how the policy has progressed and the reactions from the economy and the alterations from the administration. And I kind of think, well, if there's going to be some drama in the economy, I think there's going to be reaction from the administration, but also how are they going to implement all of these ever-changing rules and regulations on tariffs? I don't know if Doge had an effect, if they improved the efficiency and fired a bunch of people that were in charge of collecting tariffs, but like that, I think that's an open question. Is what about the
Or are they going to
enforcement
start the
and the
external? Are they going to? They're going to start the external revenue service. They announced that. I don't know if that's actually happening or not, but they had this idea that.
But at least then that implies, okay, good, because that's another layer of bureaucracy that has to be set up in order to process all of this. I would think. And maybe it's just something on a computer. You just say, well, it was zero. Now you just click on the 10% tariff button, and then that's all you need. But like, I'm just thinking of, these goods coming off the truck, and you got to have someone scanning them in or something, and or checking up on people. Who knows?
Yeah, if the government could do anything that simple, Matt. I mean,
exactly.
different administrations, before, but you remember healthcare.gov?
Yeah,
Remember
I
how
know
smooth that was?
Totally.
The website. Yeah. So this is a little more complicated.
And this is just a kind of put a pin in the stagflation suggestion here. They are expecting a little bit lower in GDP in 2025, and then a real bounce back in 2027. That seems to actually be the thrust of their outlook throughout all of the different real estate sectors they cover in this, whether it's industrial, retail, office, not as much multifamily strength actually, but for all the rest is like there's going to be a little dip in 2025 and 26 and a recovery in 2027. Well, kind of back to normal then. I think that multifamily is ahead of the game though, and I just kind of want to skip to that if possible, because I don't want to.
Can you imagine, Matt, going back to 2020 and saying, we'll basically have gotten through most of this, not necessarily the wearing masks piece and getting a vaccine, but the economic disruptions, will be not necessarily normalized until 2027 is beyond me, because I still feel like we're living in this post-pandemic world of uncertainty, inflation, and in a new paradigm in macroeconomics that no one really has the playbook, as Jerome Powell said in a speech. I think it was last year. I mean, we continue to navigate navigating
by the stars.
by the stars under cloudy skies.
Yep.
And while
I have like an
clouds
audio clip
clear
of that.
here and there, I know it's great. It's best. We got to put it on the wall. But I mean, again,
Yeah,
the
yeah,
clouds clear every once in a while. You get little bits and pieces, but no one has the charts to be able to navigate this with any degree of confidence. That's why the Fed has been so flaccid in their ability to make any decisions. But rates. I mean, if you look at where actual CPI inflation is right now, rates probably should be lower. I think we have this boogeyman of inflation.
I think
Sorry,
Powell has a real opportunity to lower rates. That'd be so bold. It'd be so cool of him. But he wants to be hockey is fine.
Well, they said they were going to do it. They said they were going to do it, but now let me ask you this, Matt, just so we can get into some hot takes. Yeah. Do you think that there's any politics that are weighing in on the decision, because it would appear that it would be an appeasement to Trump if Jerome Powell and the FOMC lowered interest rates? Are they holding steady to
I mean, that's like the double psychology.
Project independence?
Yeah. Is there holding steady in itself like an admission that they're being influenced and not independent? I don't know what the psychology or like the kind of social political struggles are informing that decision.
Trump should tell Powell to raise rates.
Yeah, exactly. That would be good. I think that there's a good case though for them not to, or for them to lower rates, because the softening that we've seen in the CPI, the lower prices in the CPI, and the suggestion that maybe all of this is because people are kind of hunkering down and reducing their consumption is, that ain't no runaway inflation. And I think that that's also seen in a little bit softer employment market. However, like maybe there's reason for them to keep it the same because it's no emergency yet. I don't know how much they want people to hurt. I think that I'm done like trying to expect to feel pain. I don't want that to be a part of the Fed's calculations anymore. But whatever. I just have this industrial fundamentals outlook up here, and because I just wanted to go through all of these sectors really quick. They expect vacancy to peak in 2026 and then start to go down in 2027. This is notable. I wanted to note it here because industrial has famously been a really strong performer in the past few years, stronger than multifamily in many cases. But in this point, their headline is softer for longer. So that contrasts with multifamily, where they talk about how demographics favor urban revival and strong structural tailwinds continue. There's lots of reasons for multifamily to be doing well, whether it's household formation, fewer adults living at home, or just other demographics that are pushing people towards some gateway markets, and actually so it's the bigger cities and these exurbs and emerging suburbs, a little bit away from the urban core, which kind of makes sense with the aging millennials moving out, maybe looking for something more suburban.
I've been at multiple conferences, Matt, this year where there's been a lot of discussion as a return to the urban core. And I mean, I'm seeing it in real time. The rents out in the suburbs, I mean, we talked about this earlier, but the rents in the suburbs aren't necessarily cheaper than downtowns anymore. I mean, there are some apartments in downtown because a lot of supply was built downtown. Then everyone moved up to the suburbs, and they have not been able to grow their rents, and they've lagged behind. You get some concessions. Whereas like the really brand new fancy apartment out in the suburb in these little like mini suburb cities, you could be paying a pretty penny because you're getting into the nicer school districts and you're getting into a little bit different, nicer, depending on who you ask, quality of life. And there probably are some deals in these urban environments. Cities aren't going away. We've talked about this in the past. There's always going to be a drive for, the social theater, being able to have a high degree of walkability, being able to go to work. The whole reason why people live in cities. Maybe it's just young people, but it's also a wide swath. It's not going away. Maybe there's more of a balance between urban and suburban. But I think that could be a really good call to look at some of these urban markets. I mean, I still prefer
kind of agree, actually,
because just the older demographics are like they're moving out of this. Some of them are moving out of the city, but all these Gen Z folks, they're not necessarily thinking that way. They still want to live in the city. I mean, again, affordability is going to make it more feasible. And there are people like that are thinking, hey, I've lived in the suburbs. I want to try this city thing, especially a lot of empty nesters. Again,
Mhm.
their kids go to college and they're like, we don't need this 4 or 5 bedroom house. Let's sell it. Let's get a place downtown, whether it's a condo, townhome, apartment,
Yeah.
whatever it may be. So I would not count cities out. It's not our core target right now.
Mhm.
But I think there could be a strong thesis for it.
Yeah, no, I totally agree. Just to sum up here, even their expectations for vacancy is a decline. So where industrial had a little bit of a jump up in 26 and then it went down in 27. In For multifamily, Cushman and Wakefield expects declining vacancy in 2026 and in 2027. Pretty consistent improvement in multifamily fundamentals. Just to push through really quick, office, they talk about jobs being down, expected to grow in the next couple of years. Some data show it says other data show RTO stability. Return to office at about 30%. Some data shows that people are increasingly returning to the office. I think that it's more like we've reached a equilibrium essentially, with 30% of full paid days are work from home days in the job market. I don't think that it's going to change very much soon. And the upshot of this all is increasing vacancy. They are really expecting vacancy to peak in 2026, but be flat and remain elevated in 2027. No recovery essentially yet for the office market, but nothing horribly worse. It's not disaster. It's just not great. And then retail, to close this out, retail also faces mixed wins. So to summarize here, industrial, a little bit of trouble. Office, a little bit of trouble. Retail, a little bit of trouble. Multifamily, it's doing okay. So I like that. That's nice, at least from the perspective of an apartment investor. This though is interesting and may have implications for the apartment market. And I'm glad they noted this. It says stress is showing. This is the 90+ day delinquency rate for all these forms of consumer debt, whether it's mortgage, credit cards, HELOC, auto loans, student loans, and other. This big jump in student loan delinquencies is because student loan repayments just started. That is a quickly developing data point, and that may yet have an impact on the apartment, because this is a renter population, recently graduated. They still have some student loans to pay off, and it only recently started kicking in. And I don't even know if if there's probably people that haven't yet paid student loans and they're not yet being penalized for it. Once they start being penalized for it, once they start kind of noticing, all right, I got to pay these now, that may mean that they are shopping for cheaper apartments. I don't know. But that's just something that stuck out to me. Also, an increase in credit card delinquencies that really shot up from 8% in 2022 all the way up to 12% now. 4%, maybe that's not a lot, but it's proportionally, that's 50% increase. And what's the other? Okay, the other, it is an other section. So I can't really ascribe anything to that, but it does seem like debt is increasing, even though consumer balance sheets, this financial obligations as a percent of disposable income, is relatively stable. Just seems shaky is the point from Cushman and Wakefield.
I wonder if that other is, a lot of the like buy now, pay later options that you've seen, pop up in the last several years.
This is
that's always worried me, because I'm assuming a lot of people do that, and all of a sudden they have a stack of bills to pay come 6-9 months later.
It does seem like this kind of sleeping thing with high interest rates, how if you were using credit cards for a certain amount of purchases before, like a few years ago, and all of a sudden now you can't make those credit card payments, even if the prices were the same. Let's say you spend $300 a week or $200 or whatever, depending on how big your family is or whatever, and if you charge it to the credit card, well, those credit card payments in 2022 are going to be a lot different than they are now because of higher interest rates. And it's this.
You mean that? I thought everyone just paid off their credit card at the end of the month. That's what everyone says they do.
Well, they say they do it. They say they do it, and then they have that money set aside. Well, okay, it costs this much to pay it off, and then it snowballs, and you kind of don't, and you don't see it. But you feel it. And
Yeah.
then maybe you notice. But yeah, that is one of the reasons why retail fundamentals are they're expected to, much like industrial, kind of jump up a little bit in 2026, and then vacancy for retail jumping up in 2026 and then going down slightly in 2027. So shakiness, not as consistently positive as multifamily, but not as consistently negative as the office. And they at the end of this they have of this mid-year overview, they talk about what it means for occupiers and investors, and they have some summative comments that is very general, but they're talking about keeping your eyes on the horizon, or focus on or reassess investment strategy. But I appreciated their viewpoint here, and the way that they highlighted the different performance and the kind of shakiness that we may see. I'll put aside all of their calls, generically or not, to like make sure you're doing a good investment at the end. Like that's maybe a lesson learned. But the fact that they are across all these different sectors are saying, 2026 may not be as strong in every area of commercial real estate as one might think. I think that's an important realization, an important thing for investors to consider. Maybe not multifamily investors, though, because
Yeah, well, I mean, the economy it's uncertain, as we've said a million times, but again, you have to have a little bit of a longer term outlook, and with the elasticity with housing brings a little bit greater confidence for multifamily over a longer period of time. I think the tough part that is keeping some capital on the sidelines, and then we're gonna wrap up after this.
Yeah.
Just don't know if there's going to be another leg down. Is there going to be that recession? Is there going to be that inflection point?
For
is
sure.
that from loan maturities? Is that, as we discussed, if there's a real true total war scenario in the Middle East, what does that do to oil? What does that do to consumer confidence? A recession doesn't increase the value of real estate in the short term. Again, long term, the fundamentals don't change materially, but that uncertainty of do you want to jump in right now before prices are going to go drop even further? Again, if you have a long-term hold period, it matters much less. But everyone wants to get as low as basic as possible. Everyone wants to be able to deliver a high rate of return. And with high interest rates, it's difficult to be able to deliver a projected level return that meets the degree of risk that is in the current market, especially with the assumptions that you have to make today, just because the range of probabilities is so much wider. So it's hard to make those decisions. It takes a lot of clarity of thought. And it takes an investor that's willing to say, I'm all right if not everything goes according to plan in the first 18 months. This is a 5 to 10 year hold. We're going to see through it. And this real estate is going to be worth significantly more in 5 to 10 years. Rents are going to be significantly more given demographics, given supply, given the inelasticity of housing. But
just go with the flow.
You have to be very solid in your convictions. Yeah, just go with the flow. I hope we don't get any copyright strikes. I mean,
No. Going with your convictions
it's all fair use.
Right? Yeah. Oh, of course. No, I think that going with your convictions is a lot different than going with the flow. You want to be able to have confidence in something that you know a lot about, that you're able to kind of work hard to ensure the success of the investment, rather than going with the flow and expecting the outside circumstances to bring you to success. But that's just my own thought. I'm not going to read into the branding of flow there, but I do think that one has to be a little bit more intentional and a little bit more proactive when you're investing, rather than passively drifting along with the currents, if I can stretch that metaphor.
Love it. Well, Matt, again, great slate. Talking about flow is always interesting, and I think it flowed really well into the other pieces.
Nice.
Just before we leave, because I have to run. I've got a great view right now, Matt, that I just wanted to share with you in the viewers. Listeners, I'm sorry. I'm just going to have to just explain what we're seeing out right now. And just cradle of civilization, and of empires. I don't know if you can see this, Matt, but got the Hagia Sophia just right over there. It was a church. It's for 1,000 years before it's converted into a mosque. I've got the palace over there. That's Asia.
Yeah.
I'm in Europe. Europe's right here. It's a wild place. I saw Byzantium, exactly, right here. I mean, we're basically the Roman Empire. Rome continued right here, Matt.
Yeah.
I saw a obelisk that was erected by the Romans in 390 AD, but it was a 4,000-year-old Egyptian obelisk.
Wow.
Sorry, 6,000 years old. It's from 4,000 BC. 4,000 BC. So it's 6,000 years old. I think they had some help. I think they had some help. It looked the condition that the obelisk is. It's incredible. I'm like, the bridges around Indianapolis that are 60 years old are crumbling. This thing.
We need some ancient aliens to help us with our potholes.
Seriously, I don't know what they were using, but it's different from what we use today. Well, thanks everyone for watching this great episode. Make sure you like and subscribe. Leave a couple comments. Let us know what you think, especially on flow. I'm curious of everyone's opinion, and also just where the market is going. And are you looking at making allocations of multifamily this year or not? And if you are, make sure that you are subscribed to the Gray Report newsletter. You get in touch with our investment team at Gray Capital if you're an accredited investor. Because we're looking at deals. We do have a lot of confidence in the market over the next decade, and we're going to take some actions here pretty soon, so you're not going to miss out if that is on your target list. So thanks again for watching. Catch you on next week's episode.
See you.